Have you ever wondered if it's possible to retire early and live off your investments? What if I told you that this dream could be your reality? Yes, you heard it right. Today we're going to explore the world of dividends and how they can fund your retirement. So let's get started. Before we dive in, let's take a moment to understand what dividends are. In the simplest terms, dividends are a portion of a company's earnings paid out to its shareholders. They are a way for companies to distribute their profits back to their investors, rewarding them for their trust and investment. But dividends are more than just a reward. They are a powerful tool for investors. They provide a steady income stream, which is especially beneficial during retirement when regular income may be sparse. But how do dividends work? Let's break it down. Well, when a company earns a profit, it has two main options: reinvest the money back into the business or distribute it to shareholders in the form of dividends. The decision is made by the company's board of directors and is influenced by many factors, including the company's financial health, future growth prospects, and industry norms. Dividends are usually paid out on a regular basis, often quarterly, providing a consistent and predictable income stream for investors. This makes them particularly attractive for retirees who need regular income to cover living expenses. Well, dividends come with another major benefit: the potential for dividend reinvestment. This is where the power of compounding comes into play. By reinvesting your dividends, you can buy more shares of the company, which in turn can generate more dividends in the future. Over time, your investment could potentially grow exponentially. Keep in mind, not every company out there is going to pay dividends. Some companies, especially those in growth stages or in certain sectors like technology, prefer to reinvest all their profits back into the business to fuel further growth. These companies offer the potential for capital appreciation, where investors make money through an increase in the stock price. So as an investor planning for retirement, you have a choice: invest in dividend-paying companies for regular income, or invest in non-dividend paying companies for potential capital appreciation, or better yet, a mix of both for diversification. In addition to these points, it's important to understand that dividends can also be an indicator of a company's financial health. Companies that consistently pay out and increase their dividends are often financially stable with reliable cash flows. However, it's also crucial not to rely solely on dividends when evaluating an investment opportunity. Other factors such as the company's earnings growth, debt levels, and industry outlook should also be considered. Now that we've got the basics of dividends down, let's discuss how they can provide a steady income stream in retirement. The key to living off dividends is to start investing early, focus on companies with a history of dividend growth, and reinvest your dividends to take advantage of compounding. Starting early gives your investments more time to grow and compound. The more time your money spends invested, the more opportunities it has to earn returns. This is why it's often said that time in the market is more important than timing the market. Focusing on companies with a history of dividend growth is another crucial strategy. These are typically well-established companies with stable earnings and strong financial health. They have demonstrated their ability to not only pay dividends consistently, but also increase them over time. Well, reinvesting your dividends is perhaps the most powerful strategy for growing your wealth over time. By automatically using your dividends to buy more shares of the company, it's a strategy known as dividend reinvestment. You can significantly boost your long-term returns. It's important to consider inflation and taxes when planning for retirement. Inflation erodes purchasing power over time, meaning you'll need more money in the future to maintain the same standard of living today. Taxes can also take a bite out of your investment returns and should be factored into your planning. While living off dividends can be an attractive strategy, it's important to note that it may not be the best fit for everyone. It requires significant upfront capital and may not provide enough income for those with high spending needs in retirement. Before we dive into some numbers, let's take a moment to consider the risks and rewards of this strategy. Dividends can provide a steady income stream, but they are not guaranteed. Companies can cut or eliminate their dividends at any time based on their financial health. This strategy may not be suitable for everyone, especially those who are starting with a small investment portfolio. That's why it's crucial to diversify your portfolio across different sectors and not rely solely on dividends for income. Diversification is all about spreading your investments across a variety of areas in your portfolio. It's a way to manage risk and aim for maximum returns, as different investments may respond differently to the same event. There is another important aspect of this strategy which we've discussed before, which is understanding the tax implications of dividend income. In many countries, dividends are taxed at a different rate than regular income or capital gains. It's important to factor this into your planning and consult with a tax professional if necessary. Another risk to consider is market volatility. Stock prices can fluctuate widely in the short term, and while this doesn't affect your dividend income directly, it can be stressful to see the value of your portfolio go up and down. You should have a long-term perspective and not make rash decisions based on short-term market movements. Moreover, investing in dividend-paying stocks doesn't mean ignoring other investment opportunities. A well-diversified portfolio should include a mix of different asset classes such as bonds, real estate, and even cash equivalents. Always keep in mind that investing always comes with risks. The value of your investments can go up or down depending on various factors including market conditions, economic trends, and company performance. Therefore, dividends should be part of a broader financial plan that includes other forms of investments and income streams. And now, the moment you've all been waiting for. How much do you need to retire and live off dividends? The answer depends on several factors including your lifestyle, expenses, and investment yield. In general, you'll need a sizable investment portfolio to generate enough dividend income to cover all your expenses in retirement. For example, if you need $40,000 per year to cover your expenses and you have an average dividend yield of 4%, you would need an investment portfolio of $1 million. However, this is just a simple example, and the actual amount you need could be higher or lower, depending on various factors. For instance, if you have other sources of income in retirement, such as a pension or rental income, you might need less from your dividend investments. On the other hand, if you have high living expenses or if you want to leave a large inheritance to your heirs, you might need more than the simple calculation suggests. But here's the exciting part. Imagine a life where your investments are working for you. You're no longer trading time for money. Instead, your money is generating more money. Every quarter, like clockwork, dividend payments hit your account. You're free to spend your time as you wish without worrying about earning a paycheck. This is the power of living off dividends. It's not just about the money. It's about the freedom and peace of mind that comes with financial independence. It's about creating a life where you're no longer tied to a job or a paycheck to pay your bills. The sooner you start investing, the sooner you can start earning the rewards. Moreover, it's essential to remember that everyone's financial situation is unique. What works for one might not be the same for another. Now, let's dive into some advanced strategies for dividend investing. Ever heard of the dividend aristocrats? These are the companies in the S&P 500 that have been increasing their dividends for at least 25 consecutive years. They're usually well-established companies known for consistently making profits. Now, why should you care about dividend aristocrats? Well, they can be a great way to build a portfolio of reliable dividend-paying stocks. These companies have proven their ability to generate consistent profits and share a slice of those profits with shareholders through dividends. They've weathered all sorts of economic conditions and still managed to increase their dividends. That's resilience for you. Another strategy you might consider is investing in dividend ETFs or mutual funds. These give you instant diversification across many dividend-paying stocks, which can be a less risky way than investing in individual stocks. Plus, these funds are managed by pros and offer exposure to a wide range of companies, reducing the risk associated with investing in just one company. And let's not forget about convenience. Dividend ETFs and mutual funds save you the time and effort of researching and selecting individual stocks. But remember, like all investments, they come with their own set of risks and fees. So, do your research before investing. Lastly, have you thought about using a dividend reinvestment plan? A DRIP automatically puts your dividends back into the stock, helping you buy more shares and compound your returns over time. It's especially beneficial for long-term investment strategies as it lets you harness the power of compounding without having to manually reinvest your dividends. Many companies and brokerages offer DRIPs, often with lower fees than buying shares outright, making them an attractive option for small investors. But keep in mind that not all stocks are eligible for DRIPs, so you'll need to check with your brokerage or the company itself. These strategies may not be suitable for everyone. That's why it's always recommended to do your own research or chat with a financial advisor before making any major investment decisions. Retiring and living off dividends isn't just a fantasy. With some careful planning and disciplined investing, it can be your reality. Start investing today and let your money work for you. And remember, it's never too late or too early to start planning for retirement. Now, if you would like to learn more about the dividends that you could generate with the Dividend Aristocrats, watch this video next.